What about when you actually inspect these records or documents, when you're actually inspecting the audit evidence? Well, inspection consists of examining records or documents, whether internal or external, in paper form, electronic form, or other media. Hopefully, it's not a screenshot you got texted to you. Inspection of records and documents provides audit evidence on varying degrees of reliability, depending on their nature and source. And in the case of internal records and documents, on the effectiveness of the controls over their production. An example of inspection being used as a test of control is when you inspect records or documents for evidence of authorization. If a process to move cash involves two managers signing off on it, you want to make sure that where's the form where both managers signed off on the movement of this, let's say, batch of $10,000 that's being moved. That's something that could be critically important for a company, right? Moving cash is a very sensitive action. I mean, everyone wants cash individually, so there's a lot of potential for fraud. If a control says that, like I said, two managers need to sign off on it, you want to make sure where's the form that proves that two managers actually did it. That would be sampling, testing controls, and getting that audit evidence for authorization. Some documents represent direct audit evidence, such as the existence of an asset. So, for example, a document constituting a financial instrument, such as a stock or a bond, right? So if you've got a stock certificate saying, congratulations, you're the owner of one share of McDonald's, thinking back to what I got as a kid, just a gift, got that framed certificate. Oh, wow, I'm going to be a big business person someday, right? But as an actual company, as an actual entity, you'll have paper documentation saying you're entitled to 500 shares of the company you invested in. Inspection of such documents may not necessarily provide audit evidence about ownership or value. That's true, right? Because values fluctuate, right? And then ownership, well, it's a piece of paper. It can't be particularly updated, so it might have been sold since then. In addition, inspecting an executed contract may provide audit evidence related to the entity's application of accounting principles, such as revenue recognition. If you look at the contract that was signed, let's say you're auditing a construction company, look at that contract, see what the amount was agreed for, see when they're going to bill the client. Maybe are they accidentally or maybe maliciously recognizing revenue when they receive it, which that's not GAAP, that's cash basis accounting, and that would be a problem. We want to look at what the terms are for the revenue recognition and making sure it complies with GAAP. You want to look at that and make sure everyone's following the rules. Inspection of tangible assets. This is going to be inventory, PP&E, everything like that. Inspection of tangible assets consists of physical examination of the assets. Inspection of those tangible assets may provide appropriate audit evidence with respect to their existence, but not necessarily about the entity's rights and obligations or the value of the assets. If you're looking at a machine that the client has that makes products, right? It's a machine that makes shoes. Maybe you're auditing Nike, they make shoes. If you see that machine that they listed on their balance sheet, right, that production machine, great. You've verified its existence. But did Nike pledge that as collateral possibly, which would mean that they don't have the right to it, which would mean that they should disclose and account for that properly? And also, what is that machine valued at? Well, just because you saw it doesn't really prove to you what it's valued at. You'd have to bring someone in to give it a fair value assessment or look at documentation, right? Use an assessment valuation procedure. Inspection of individual inventory items ordinarily accompanies the observation of inventory counting. So you want to see, okay, you counted the inventory, but then you want to take a look at a few of the products they're selling, right? Are they fake products? So for example, when observing an inventory count, the auditor may inspect individual inventory items, such as opening containers included in the inventory count to ensure that they're not empty in order to verify their existence. I've heard individuals going to test barrels of oil, sticking a rod down the barrel of oil and making sure that there's actually oil in it, right? You pull the stick back up, make sure it's covered in oil, trying to make sure, that valuable commodities, valuable pieces of inventory are actually there and they're not there to fake and possibly overstate assets. Next up, we've got observation. Observation consists of looking at a process or procedure being performed by others. Examples include observation of the counting of inventories by the entity's personnel. Bolded there because, important point, we don't actually count it. It's the entity's personnel who count it. We just observe them counting it. And observation of the performance of control activities. Again, we want to make sure that we are watching how the internal controls are actually conducted, making sure that if an employee submits a receipt for reimbursement, we want to actually test that. We want to observe, okay, they submit a receipt for reimbursement, that gets sent to a manager for approval, then that gets sent over to the department, which will then reimburse the employee for their expense. You want to make sure that those internal controls are functioning properly by observing them. Observation provides audit evidence about the performance of a process or procedure, but it is limited to the point in time at which the observation takes place, and by the fact that the act of being observed may affect how the process or procedure is actually performed, meaning if there were problems with the process before we tested it, and obviously we tested it now and maybe it's okay, we would not have detected those issues, or maybe there'll be issues after we test it. We obviously still would not have detected those issues. And then also, if the client knows you're watching your procedure, they might do it right that time as compared to how they normally conduct their process, which maybe is incorrect. Inquiry. Let's dive into this procedure of inquiry. Inquiry consists of seeking information of knowledgeable persons, both financial and non financial. You can inquire of management, you can inquire of the board of directors, you can inquire of certain employees in the entity. Inquiry is an audit procedure that is used extensively throughout the audit and is often complementary to other audit procedures. Inquiries may range from formal written inquiries to informal oral inquiries. Evaluating responses to these inquiries is an integral part of the process. So even if you're just asking someone orally, you're not actually writing it down, you want to obviously make documentation. Say, hey, I asked management if there was any fraud. Now, if I asked the staff accountant for the client if they knew of any fraud, we want to make sure that we are documenting those inquiries. It normally involves considering the knowledge, objectivity, experience, responsibility, and qualifications of the individual to be questioned. We will also want to ask clear, concise, and relevant questions. Also, using open or closed-ended questions appropriately. If we want a yes or no answer, we're going to ask a closed-ended question. But if we possibly want to give someone the opportunity to elaborate further, kind of give more details, maybe if they know of any issues within the accounting system, we might ask an open-ended question. We also want to listen actively and effectively, make sure that we're not going to miss anything they say. Next, considering the reactions and responses and asking follow-up questions. If an employee knows about fraud, they may be hesitant to talk about it for fear of being fired. So you want to see, hey, is this person maybe trying to hint at something, right? You're kind of like a little FBI agent, right? doing the good work. We obviously don't have the authority that the FBI does, but kind of think of yourself like a private investigator. You're trying to get down to business and understand if there's any fraud or any error. Lastly, we want to evaluate the response, talk about it with the other members of the audit team, and see if they have any thoughts on the matter. A little bit further on inquiry, in some cases, the auditor should obtain replies to inquiries in the form of written representations from management. So, for example, when obtaining oral responses to inquiries, the nature of the response may be so significant that it actually warrants obtaining a written representation from the source. If we specifically ask management, hey, I know that department of yours has had multiple issues throughout the past couple of years, there's been high turnover. Do you believe that, or have you looked into that department and seen any problems with internal controls or the actual numbers? If they say no, and they say, yes, we've actually looked into it, we've done extensive investigations, and we think that department is actually totally under control, then you want to get that in writing as a part of your audit evidence. Responses to inquiries may provide the auditor with information not previously possessed or with corroborative evidence. Alternatively, responses might provide information that differs significantly from other information that the auditors obtained. For example, information regarding the possibility of management override of controls. Management's probably not going to hint at the fact that they have the ability to override controls, but maybe a staff accountant, someone below them will say, hey, actually, yeah, I see an opportunity for management to override controls, and I want to bring it to your attention. In some cases, responses to inquiries provide a basis for the auditor to modify or perform additional audit procedures. Lastly, the auditor should resolve any significant inconsistencies in the information obtained. If you ask 3 different people in 3 different departments and they give you different responses, you say, hey, we see the sales department. Do you know of any issues in the sales department where they're getting overpaid or maybe their bonuses are being withheld? And you get different responses from everyone. That could be something to look into further. The auditor should perform audit procedures in addition to the use of inquiry while we are inquiring. And we have the management representation letter. If we could just trust that, we wouldn't actually have to do anything. But in addition to asking questions and having people give you responses, you actually need to do other procedures. Shocker, right? So inquiry alone does not provide sufficient appropriate audit evidence to detect a material misstatement. Moreover, inquiry is not sufficient to test the operating effectiveness of controls. Yes, we can ask the people who work at the company. It is our job as the auditor to, yes, get those points of inquiry, get those written and oral statements from individuals and members of the entity, but then also to perform procedures in order to verify all those statements. But although corroboration of evidence obtained through inquiry is often of particular importance, because you're getting these written statements from people attesting to something, there's a lot of weight to that. Whether it's management saying that internal controls, to the best of their knowledge, are functioning properly, or getting a statement from the entire accounting department that none of them know of any fraud. Now, in reality, maybe there is a lot of fraud there, but that is them taking responsibility for something. So, yes, this is of particular importance. In the case of inquiries about management's intent, the information available to support management's intent may be limited. In these cases, understanding management's past history of carrying out its stated intentions with respect to assets or liabilities, management's stated reasons for choosing a particular course of action, and management's ability to pursue a specific course of action may provide relevant information about management's intent. If they give you a statement saying, yes, we are going to change this one thing that you told us to do, if the auditor says, hey, that internal control is not functioning properly, you need to change it, management says, sure, we will do that. You also need to look at management past. Has management in the past actually followed through with any recommendations from the auditor? Have they had issues with the auditor? You want to make sure to assess all of these factors. Let's talk about confirmation, this process, this wonderful testing procedure. This is a specific type of inquiry. It's the process of obtaining a representation of information or of an existing condition directly from a third party. You send a form to the bank, say, this is how much the client says they have on their balance sheet. Is this how much cash that you have in the bank account for them? You could send it to customers saying, hey, this is how much the client says you owe them for an accounts receivable. Is this how much you owe them? You could also do this with debt. You could do this with pretty much anything that a third party would have. Those are just the more common examples. So, for example, the auditor may seek direct confirmation of receivables by communication with debtors. The confirmations are frequently used in relation to account balances and their components, but need not be restricted to these items. As I said, if you see a use for it, go ahead and use it. The confirmation request can be designed to ask if any modifications have been made to the agreement, and if so, what the relevant details are. For example, the auditor may request confirmation of the terms of agreements or transactions an entity has with third parties. Confirmations also are used to obtain audit evidence about the absence of certain conditions, for example, the absence of undisclosed agreements that may influence revenue recognition. Any third parties that you think you should communicate with and get anything verified with them, definitely I would recommend using a confirmation. Recalculation, this is just the process of the auditor redoing the math, right? Hey, did the client accidentally have an error? Or maybe they're trying to commit fraud or misstate something. Recalculation consists of checking the mathematical accuracy of documents or records. Recalculation can be performed through the use of IT. For example, you get an electronic file and you use different softwares to check the accuracy of the summarization of the file. You want to make sure if they said they had 100 transactions, there are 100 transactions. If all the transactions add up to the balance that they have listed on the financial statements, you want to make sure that all of this is checking out. Reperformance. This is the auditor independently executing and performing a procedure that the client normally does, originally performed as a part of the entity's internal control. So you could have a process where in order for the company to take out new lines of credit, new debt, it needs to get approved by a certain manager. You can go and see what was that control properly executed, right? In the most recent time, the company tried to take out debt. Did it actually have to get approved by that manager, or did they actually just go around that manager? Analytical procedures, right? We talk about this in planning. We talk about this in use throughout the audit to gain overall understanding. You want to compare financial statements from year to year to see if there are any relationships between them, to see if revenue has spiked or if debt has spiked, right? Any of these accounts, if they've significantly changed percentage-wise. Analytical procedures consist of evaluations of financial information made by a study of plausible relationships among both financial and non-financial data. Analytical procedures also encompass the investigation of identified fluctuations and relationships that are inconsistent with other relevant information or deviate significantly from predicted amounts. So both revenue and accounts receivable should be in correlation with each other. What's the normal journal entry there? We debit accounts receivable, we credit revenue. So as such, they should be pretty similar over a certain period. If they're not, we can use analytical procedures to detect that and then further conduct some sort of audit testing to come to a conclusion of what happened. Here we're going to talk about analytical procedures as it relates to our audit evidence. Well, in analytical procedure, it could be something such as scanning. And this process of scanning is the auditor's use of professional judgment to review accounting data, also possibly audit evidence, to identify significant or unusual items and then to test those items. And then we could scan those particular transactions possibly, and then we're going to collect audit evidence based on those. This includes the identification of anomalous individual items within account balances or other data through the reading or analysis of entries in transaction listings and all of these different client-related files. Scanning includes searching for large or unusual items in the accounting records. So, for example, non-standard journal entries as well as in transaction data. So, for example, we've got adjusting journal entries. That's a good example here. For indications of misstatements that have occurred. We can use these computer-assisted auditing techniques or tools to assist us in identifying these anomalies. Since the auditor tests the items selected by scanning, the auditor obtains audit evidence about those items. And the auditor's scanning also may provide some audit evidence about the items not selected, since the auditor has used professional judgment to determine that the items not selected are less likely to be misstated. Here's a great little graphic. We've got this for the reliability of audit evidence. On this end of the spectrum, we have the highest reliability of evidence. And here we have physical evidence, where you physically observed it, right? Something like an inventory observation. Now, on the complete opposite of the spectrum, we've got the lowest reliability of audit evidence, which would be client representations. This is technically audit evidence, although it is not as reliable because it's just someone saying something. And yes, while that is great because you can hold them liable for it, they've said it, it's also, and most people aren't going to lie, right? Unfortunately, some people do. But because that, some people do lie, it's not going to be that reliable. And examples of this would be the management representation letter. Less impactful will be oral representation, someone saying something, because this is a formal, recognized document which management knows holds some severity. Whereas if someone just says something in passing, that's going to hold less legal weight. In the middle, we have documentary evidence. So this is going to be obviously external evidence, as we mentioned, is going to have your highest reliability, whereas internal is going to be less reliable there. Examples of external evidence could be a cut-off bank statement because you get that from the external source of the bank, whereas internal evidence is a sales invoice, and since that is generated by the client for their sale they make, this could be edited, it could be modified. So that's why, well, yes, is there a likelihood that the whole accounting system could be corrupt? It's possible, right? It's possible, but unlikely, and well, that's something you would test for in your test of controls, but that's just something to keep in mind, is that it's less reliable because it's not a third party. And lastly, here we have a purchase invoice. Now, this would be if the client purchased something from a third party and that third party sent them an invoice. And you may be saying, well, okay, cool, that evidence, that actually should be external, right? So since it's external, that audit evidence would actually be reliable. But in this case, it actually wouldn't be because the client gets that invoice from the third party, and then the client has the opportunity to possibly edit that. And so as such, yes, it originally supposedly came from a third party. However, now it's in the hands of the client, and once something's in the hands of the client, it is less reliable because the client can potentially edit it. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.